Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover some topics related with depreciation, impairments, and depletion. In this audio, we're going to talk about a modified accelerated cost recovery system. This is a depreciation system required by tax code. There are three differences between this modified accelerated system and this GAAP depreciation system. For example, tax codes are very specific about the tax life of property. Okay, in the GAAP system, managers could estimate the useful life of a property, but here they have to follow the tax code. And secondly, they are very specific about the method, the depreciation method, and very specific about the salvage value. Salvage value equals 0. Firms don't adopt one method for both tax and book purposes in all cases, which means that they use modified accelerated system for reporting taxes, and they use the GAAP depreciation system to calculate the depreciation expenses on income statement. To be able to calculate depreciation expenses, we need to know the useful life of different properties. Here, under the tax law, it is called tax life. Okay, this is a little table demonstrating the requirements from tax laws. For example, 3 years is going to be used for those small tools, horses, assets used in R&D activities. 5 years used for automobiles, trucks, computers, peripheral equipment, and office machines, and so on and so forth. So if you want to calculate depreciation expenses under tax laws, you have to first follow this chart to get the tax life of your property. In terms of depreciation method, we can use tax laws very specific. For example, for the 3, 5, 7, 10-year property, double declining balance method needs to be used. 15-year and 20-year property, 150% declining balance method will be used. 27.5 and 39-year property, straight line method will be used. And in the year of acquisition and disposition, only half of the depreciation expenses using those methods is allowed. Now, let me show an example to demonstrate the difference between these two systems. Suppose ABC Corporation just purchased an automobile on January the 1st, 2014. Our job here is to calculate the depreciation expense under the tax and under the GAAP for the financial reporting purposes. Here are the information. Historical cost, $40,000. Tax life of all the automobiles assigned to be 5 years. There's no choice for the managers. Well, under the GAAP, managers estimate that the useful life is 10 years. Salvage value under tax is assigned to be 0, while the salvage value is estimated to be $2,000 under GAAP. Okay, depreciation expense under the tax for all these 5-year property, we should use double declining balance method. Well, under the GAAP, managers choose to use straight line method. Okay, now in the next slide, I'm going to show you the difference in terms of the depreciation expense between these two systems. Now, the 2014 depreciation expenses will be very different between these two systems. Under the tax system, what we're going to do is we're going to use the historical cost of $40,000 times 2/5. This means that we're using the double declining balance method, DDB. Okay, and since this is the first year, in the first year of acquisition, the depreciation expense under the tax needs to be cut into half, so divided by 2. So in the first year, under the tax, the depreciation expense is $8,000. Under the GAAP, since we're using a straight line method, depreciation expense equals your acquisition cost minus salvage value divided by 10 years of the estimated useful life. Every year, we're going to depreciate $3,800. We could also use optional straight line method under tax, which means that we can apply the straight line method to those 3, 5, 7, 10, 15, 20 years of the property, those 6 classes of the property, and still assign salvage value to be 0. We still need to cut depreciation expenses to half, in the year of acquisition and disposition. This is exactly what we just talked about, a half-year convention.